Hey, what's good, you guys? So today I'm going to talk to you about why you got to stop buying stocks and you got to start doing some real stock market investing. Yes, I said it. Stop buying stocks and start doing some real investment. Okay, well, what do you mean, Lucio? Well, Warren Buffett says that if you're not willing to hold a stock for 10 years, then you shouldn't even hold it for 10 minutes. So what does that mean? That means that basically you got to analyze a stock as if it was a business whenever you're buying it. Don't just buy it because you think it's going to go up. Don't just buy it because it's the trending thing to do. Buy it because you're buying a piece of the business and you're comfortable with the returns that you're going to be getting every single year. So now let me break it down to you guys. If you don't know the following terms, then don't even touch individual stocks. And I will give you at the end of the video, I'm going to give you an alternative investment that you can use to where you can still be plenty in the market. Now, if you don't know what PE ratio, 10Ks, enterprise value, CapEx, change in net working capital, FCF, beta, alpha, market premium, risk-free rate, VIX, discount rate, earnings per share, EBIT, and EBITDA. If you don't know what any of those terms mean, you have no idea how to calculate them, then that's a clear red flag that you shouldn't even touch individual stocks. Now, why am I saying this? I'm saying this because these are the fundamentals, these are the foundational terms that you need to even start to calculate if the stock is actually overpriced or if it's undervalued. Right? Which would basically tell you, is this a good opportunity or is this a bad opportunity? And most people are not going to go through all this because the people that do that are usually only corporate finance people whenever they're trying to buy or invest in an individual company. Now, that's just one aspect of it. That's only the technicalities. That's not to include all the emotional things and all the capacity that your brain is supposed to have whenever you're analyzing the stocks. So if you don't have the accounting abilities of a CPA and you're willing to audit this company's financials as if you were an auditing accounting firm, that's one sign you shouldn't touch it. If you don't understand the financials the way the CFO does or should understand the company's financials, don't touch the stock. If you don't understand how economics will affect the individual company that you're buying, then you should, like the way that an economist does, then you shouldn't buy the stock. If you don't understand the way politics are going to affect the company, the way a congressman would understand, then you shouldn't buy the stock. And most importantly, if you do not have the emotional wisdom of a monk, then you should not buy the stock. Now, we all think that we can buy and trade stocks in a profitable manner the way that Tudor does or the way that Warren Buffett does. But what you don't understand is that Warren Buffett has a master's in economics and he was raised by a stockbroker and he spends 8 hours of his day reading 10Ks and annual reports and any of the financials that he can get on those individual companies. Now, we both know that neither you and not even I am willing to do that. As a matter of fact, me, the guy that's always getting in front of you, talking to you about finance and what you should do with finance and investments and this and that, actually only owns one individual stock. So if I only own one individual stock, what makes you believe that you should own multiple individual stocks or should trade multiple individual stocks? Now, that's not to say that I'm smarter than you. This is basically saying that I'm the guy that's always studying. I live this, I breathe this. I spend most of my time reading documents about finance, reading articles about finance. And if even me, I could only pull the trigger on one individual stock, then trust me, you're running a lot of risk by doing it yourself. So this is what we call in the industry firm-specific risk. Firm-specific risk means that you're running all these risks on that individual company. But Lucio, everybody tells me that I gotta start investing, that I gotta do it now, that I gotta do it in my 20s, because if I do it in my 20s, then I got all this time for the interest to compound and the growth to compound, and I can retire comfortably. That is true. So the alternative would be investing in what we call mutual funds. Mutual funds is basically a packaged product with hundreds or thousands of stocks that you're buying into. So if you're investing $500 a month, why invest $500 a month in Uber when you can invest $500 a month in Uber, Lyft, Snap, Facebook, Instagram, what we call the tech sector or a tech sector fund? That way, your money gets spread out through all these companies and you're investing in them as a whole, which what that does is that minimizes what we call the firm-specific risk. Let me give you another example. Why invest in Apple when you can invest in Apple, Google, Chipotle, Exxon, Chase, Starbucks via an S&P 500 mutual fund? What that means is that it spreads your investment, your $500, amongst the 500 largest companies in the world. Excuse me, the 500 largest companies in the US. That's it for today, guys, but I will have more videos coming to you specifically on mutual funds and how you can invest in them and what to avoid when it comes to mutual funds. Stay tuned. And once again, guys, stay financially woke. If you feel like this video brought value to you and makes you understand finances just a little bit better, please do me a favor and share it below.